Financial Modeling, Topic 1A, Estimating Asset Expected Return. In this topic, we're going to calculate expected return, which are needed in many different cases in finance. For example, constructing optimal portfolios, you need to know the expected return and standard deviation of assets. Planning for retirement, you need to know the expected return of your securities, including equity funds and individual stocks. Valuing equities, you need to have a discount rate to discount your cash flows. And forecasting corporate cash flows, you need to know the expected return of certain assets in certain circumstances. So in this lecture, besides just using Excel styles and formats and manipulating calculations in Excel, we're going to compute the historical returns for stocks and market indexes using arithmetic and geometric return. We're then going to use several models to calculate the expected return of a stock or a fund. We're going to use CapM, Global CapM, the fama-french three-factor model, and fundamental analysis. I'm going to grab some data that I've collected. So this data and some formats ready for us to fill in is embedded in the PowerPoint in Excel. So I'm going to copy that whole range. I'm going to do a copy, Control C, get out of there, go to my Excel spreadsheet, and paste. So here's the data I've collected. All right, the data is from finance.yahoo.com, historical monthly adjusted prices, and the securities are IBM, Goldman Sachs stocks, J&J stock, IOO, which is an S&P 500 global, S&P Global 100 ETF, SPY is an S&P 500 ETF, EFA, which is a Europe, Australasia, Far East Developed Market Index fund, so it tracks developed markets, excluding the US and Canada, so it would include economies like much of Western Europe and Japan, Germany, the big economies, Australia. And then EEM, which is an ETF that tracks emerging markets. You can think of those as the BRICS, Brazil, Russia, India, China, and many other emerging market countries. So those last two funds, we usually call them EFA and EMA, again, developed market and developing markets. And in the spreadsheet, I'm going to use styles. So if you go to Excel, Home, Styles, you'll notice Excel has some standard styles. So I'm going to use input whenever I input a value in Excel. That way, if I need to change any input, I know where to go. I'm going to use calculation. For many of the times I use calculation, so I know I don't need to change those cells. And then sometimes I'll use output and check cell, and sometimes I like to use this blue accent. And for me, I usually make that the main output of the spreadsheet. I accent it, so if someone wanted to jump in and try to find what's important here, it's going to be what's in blue. I also have the current Treasury rate. Treasury bond rate, 10-year Treasury bond rate is about 195 as of early 2015. I have an estimate of the market risk premium, which is the expected return of the U.S. equity market or equity markets over Treasury bond rates. And that's just an estimate. I put in a 5%. And I also have the T-bill, annualized T-bill rate as of this time period. So for these stocks, I want to first calculate an arithmetic average return over this period. So if I go to the little area of the spreadsheet right here, as IBM Returns, I'm just going to put in equals, open parentheses, the November price minus the October price divided by the October price. So that's P1 minus P0 over P0, your percent change formula. And that'll tell me that IBM's return in November of 2014 was negative 68 basis points. I'll copy that down. So now I have returns going back to 2004, although I have to delete that last return since there's no price to point at. All right. Also, notice I used a little trick there. And that trick is that if you have one calculation next to a column, if you double click on the lower right hand corner, it'll autofill to the bottom of the column to the left. So I use that. Now I can copy that formula, and then I can use that for J&J, Goldman Sachs, IO, and SPY, EFA, and EMA. All right, we'll explain later how we're going to use these. We'll also explain later what this FF3F data is referring to. So here are monthly returns for my 1, 2, 3, 4, 5, 6, 7 securities. So I can come back up here and let's calculate the average arithmetic return and annualize it. So I'll just take the average of the IBM returns. I'll just click on the first one and then I'll hold down Shift. I'll hit my N button and down and go to the bottom of the series. Close my paren, and there's the monthly return. I'll multiply that monthly return by 12. There's my annualized annual return from the data of 2004 through 2014, almost 11 years of data. I can copy that across by dragging this across, and there are my average annual returns for IBM, J&J, Goldman Sachs, S&P 100, S&P 500, IFA, and EMA. Now there's one other historical return that people often use. It's called a geometric mean. So our arithmetic mean is just a monthly average. So if you have 10 months, you divide by 10. In this case, we had 130 some months. We took an average and then multiplied times 12 and got an arithmetic return. But geometric mean, all you do is take the last price, divide by the oldest price, and raise it to the 1 over number of periods in your data. So this data has about 11 years, almost exactly 11 years. So if I take the last price, open paren, last price of 162, divided by the oldest price, $83. I then raise that to the 1 over 11 power and subtract 1. It tells me it had a geometric mean of 626. Now, geometric mean is in many circumstances is more important. So let's talk about talk about why it's important to have geometric mean. If I had to forecast what IBM's return solely on this historical data set, all I had was that, I would guess 795. All right, that's the arithmetic average. However, if I had a problem that required me to have an annual return for IBM, I'm going to use that to forecast the price for 30 years. Or actually just for 11 years. Let's make it that way. I'll just use this space down here. So if I had to say that the initial stock price of IBM again was $83, and I multiplied that times 1 plus the arithmetic mean, 795, and then compounded that for 11 years, notice the price turns out to be 192, which doesn't make sense because the actual price is 162 we used in the data. That's because you're getting the compounding effect. That 795 is compounding every year. So you're getting interest on, or return on return. But now if I just take this formula and instead of using the arithmetic mean, I use the geometric mean, I now get 162, which is exactly the price. So in other words, if you have to do compounded returns over time, you definitely want to use geometric means. Otherwise, you're overstating the value of the asset. So if all I have was historical data and I needed a 1-year number, I would use arithmetic mean. If I had to use it in an equation that did compound returns, I would use geometric. But I'm uncomfortable using historical returns for assets, namely because, well, depending on what time period you did, maybe if I did this exercise right after the crash a few years ago, all these returns would probably be negative, so I wouldn't forecast that. So what I would probably do is use a model. The most common model for forecasting returns is capital asset pricing model. We're going to use that. We're then going to use a newer model called the fama-french model. Then I'll show you how to use fundamental analysis to forecast expected returns. So let's talk a minute about CapM. CapM is a model for forecasting required or expected returns of an asset. And the model makes some huge assumptions. those assumptions are that the marginal investor buying, say, IBM stock is already diversified in a market portfolio. In other words, they have a very broad portfolio of assets, and they're just going to add IBM to that market portfolio. Therefore, when we're thinking about, well, I think there's a relationship between risk and return, right? Higher risk should lead to higher return. But if I'm trying to evaluate, well, what is the risk and therefore what is the expected return of IBM, I'm not looking to look at the total risk of IBM, right? The total risk of IBM would be their standard deviation, historical volatility of the actual stock return. But if you assume that the marginal investor already has a diversified portfolio, you want your risk measure to be, well, how does that stock's return affect my total market portfolio? And that's going to be measured. We're going to call that market risk, and we're going to measure that using beta. And then once I have a measure for that, I need to get the average compensation for taking on market risk. We'll call that the market risk premium. So the CapM formula is the return of any individual asset I, the expected or required return of, say, IBM, is at least the risk-free rate, because I wouldn't hold a risky asset if it didn't give me the risk-free rate of return. And I'm going to use a long-term treasury rate, 10-year rate, plus a compensation for the risk of that asset. And that compensation is measured by its market risk. We're going to call that beta, times the compensation for units of market risk. We'll call that market risk premium. So where do I get this data? Risk-free rate, I'm going to use the current 10-year treasury yield. Some people like to use T-bills. I like to use T-bonds. I think it's more common to use long-term assets because I'm thinking about holding a stock versus holding another long-term safe asset, and that would be a T-bond. I wouldn't think about holding a stock or holding T-bills. I'd probably think about long-term bonds or long-term equity investment. All right, the beta, that's going to be measured by getting the sensitivity of your stock to the total market. So what we'll do is we'll regress, say, the excess returns of your stock, excess returns being the return minus the risk-free rate for that period, against the S&P 500, say, returns minus the risk-free rate. So each one of these dots might be the actual return of, say, IBM versus the return of S&P 500. And then if I ran a regression, it'll give me a best fit line across through this data. The slope of that line gives me the relationship between the returns on the stock and the market. And we'll have that as a measure of our market risk. So beta measures the market risk, 1 meaning it's about as risky as the market. Greater than 1 means it's more than riskier than the market, and less than 1 means it's relatively safe. And then we need a compensation for unit of risk. So think about if the beta is 1, that means it's as risky as the market. The market has a beta of 1. So the market risk premium is, well, if I have a beta of 1, the market, what compensation should I get? Well, I can look historically and then see that, well, historically, based on, if you're doing 40, 50, 60, 20, 80 years of historical data, you can make the case that the equity market has a 4, 6, 8, 10% excess return over T-bonds, depending on the time period. So I'll use that as my market risk premium, usually 3, 5, 7, 9, 10%. In practice, most people use a market risk premium of about 3 to 7%. All right, market risk premiums, you can also use something called an implied risk premium. So if you were to Google, say, Damodaran, Aswath Damodaran at NYU, go look at his data sets. He publishes something called an implied risk premium every year, and I like to use that sometimes. What he actually does is he uses the current value of the S&P 500 every year, forecasts the cash flows of all the S&P 500 companies using Bloomberg estimates of all those companies, and kind of backs into the expected return of the market over the next so many years. And looking at the current stock price estimates the expected return of the market over the treasury rates, or treasury bond. That would be called an implied risk premium. At the early 2015, I think that estimate is about 6%, but you can go to his website and you can see that. All right, so that's CapM. I'm going to earn the risk-free rate plus my measure of market risk times my market risk premium. I'm also going to do a slight variant of that model called global CapM. And the only difference is when I run this regression to calculate the beta, I can either run it against, say, the S&P 500 and call that the market, or I can run it against a global equity market index. The difference is the assumption: is the marginal investor in IBM globally diversified, or are they simply diversified across U.S. equities? The evidence tends to say that there's a home market bias. The marginal investor of any country pretty much is underinvested in foreign equities, so there's a good evidence that using a domestic CapM is good enough. But for some asset classes, when I try to get the expected return of, say, the EMA or EFA fund, I might use global CapM because I might make the assumption that the marginal investor of an EMA fund, an emerging market equity fund, may be already globally diversified. So I might regress that against a global equity fund. So let's go ahead and calculate our CapM returns for these stocks. The first thing I need to do is run a regression of these asset returns against the market, and I'll use the domestic market, SPY, and then I'll use the global market, IOO. So I need to run a regression. I could run a regression using Excel's data analysis tools, but if all I'm doing is a single variable regression, I can use Excel's slope function. So I can run the slope when I regress IBM returns comma, so I just highlighted IBM's returns, and then I'll select shift and down let me try that one more time. So I'm going to do slope, grab IBM's returns, comma, and then I'll do the market returns as my X variable in a regression. I'm sorry, the market returns. Shift and down, close paren, and there's my beta. All right, so my beta is going to be the slope function of IBM's returns regressed on the market returns. Now I'm going to edit this formula. I'm going to highlight the S&P 500 returns, and I'm going to hit F4. That's going to put dollar signs or anchor those cells. That'll allow me to then copy this formula across, and that'll give me the betas of all these assets against the S&P 500. So you can see that J&J is the safest asset, followed by IBM. You can see Goldman Sachs is the riskiest. Actually, let me just make sure I have this against the S&P 500. Let me look against this. I might have picked up IOO by mistake. Oh, I did. So let me slide this over. So in my formula, I can then just slide this over here. That'll change the formula. I'll hit enter. That looks better. So there's my domestic CapM betas. I know that because the beta to SPY should be 1. Right? The beta between a stock and itself, or asset and itself, will be 1. So again, we see J&J is the safest, followed by IBM. Goldman Sachs is relatively risky, having a beta of 1.4. So you can think of it as 40% more risky than the market, and so on. And then I'm going to do the same thing for global CapM. I just simply need to, I'm going to copy this formula and just kind of adjust it a little bit. I need to capture IBM's returns against IOO. So I'm going to take my formula, make sure I have IBM's returns. I had to move that up a little bit because it got dragged down. And I'm going to switch this over to get IOO's returns. So now I have a slope of IBM's returns against IOO's returns, and I can copy that over, and you'll see as the beta between IOO and IOO is 1. That's why I know I got it right. And those are my global CapM betas. Now I can do a CapM formula. Now CapM formula is risk-free rate plus beta times market risk premium. I'm going to use name ranges. So here's my current T-bond risk-free rate. I'm going to call that RF by clicking on this upper left while in this cell. So now that's a named range of RF. Market risk premium, that 5%, click on that. See it's in cell A2. I'm going to give that a named range of MRP. And while I'm here, let me give this a named range. This is going to be my risk-free rate when I do a fama-french model. So I'm going to give this a named range of FFRF for the fama-french risk-free rate. So now I can do my formula. CapM, it's going to be risk-free rate, plus my beta, 0.72, times my market risk premium. Notice how these cells have highlighted because it's now referencing these two cells. So there's my CapM return for IBM. If I copy this down, it'll give me global CapM because when I slide the formula down, it captures the next beta. And since we're just calling this 5% of market risk premium for all equities, we can use it for both. And I can copy that across, and now I have CapM and global CapM returns for my assets. And again, the difference is I might use CapM for domestic equities, and I might use global CapM for these larger international equity or asset classes. So just looking at IBM, I now have an arithmetic average of 795, which I'd use for one period, a geometric average of 626 that I use for multiple period compounding, CapM of 556, and a global CapM of 499. So that's how you do CapM. Now the advantage of CapM, it's very theoretically appealing. I like the idea that every asset has a risk-free rate plus a compensation for risk, and if you assume investors are rationally diversified, that risk should be market risk. CapM is widely used, requires relatively few inputs, risk-free rate, beta, and market risk premium. The disadvantages of CapM is one, is we don't really know what the market risk premium is. You know, people use 3 to 10% pretty commonly. I use about 4 or 5 or 6, or 4 or 5 usually. And the reason why is if you use historical returns of the stock market over bonds, it depends on what horizon you use, and you get different estimates. I will again mention, if you were to look at Aswath Damodaran's website at NYU, he does a forecast of risk premiums by looking forward-looking at the current level of the stock prices and forecasted cash flows, and gets an implied risk premium. Also, a disadvantage is if I did an R-squared. Well, if I run a regression and calculate an R-squared, what you'll see, let me change this to less than, what you'll see is the R-squareds are often less than 50%, often 20 or 30%. So in other words, when I run regressions to see if what percentage of the return of IBM is explained by the market, you often get numbers of 20 or 30%. So some other factors are out there. Also, betas are changing over time. If I looked at, say, eBay a decade ago, the beta might have been 3, and then 5 years ago it might have been 2, and now it might be closer to 1. And what happens is, as firms mature, they just look more like the market. They're just more mature and stable and larger. So that always makes beta estimation troubling. Also, do I use 1-year betas or 5-year betas or 10-year betas? One common practice is to use, say, a 2 to 3 year historical beta. So I might use, say, 3 years of historical data. And they have done studies that show that betas tend to go towards 1 again over time. So one method of estimating beta is use something called an adjusted beta. There's been a study that says that betas tend to 1, and one way of estimating that is to take 2/3 of a regression beta, say take 2/3 of 0.72 or 2/3 of 1.42, and then take 1/3 of 1. And what it would do, it would push all these betas closer to 1. So you might use that if I want to forecast cash flows for 10 years and use CapM to discount the cash flows. I might assume the betas start going closer to 1. Lastly, there's been a lot of attacks on CapM saying, well, there's other factors that seem to drive equity returns. And the two big ones we'll talk about is size and book value. It's been shown, let me change that small stocks tend to outperform large stocks. So small cap stocks tend to outperform large cap stocks, and that's relatively persistent. And high book-to-market value stocks tend to outperform low book-to-market stock. And that is book value of equity divided by market value of equity. So it's the stocks that aren't so sexy and aren't being priced highly. So that's kind of like low PE stocks would be high book-to-market stocks. So these stocks tend to outperform other stocks. And it's not explained by beta, right? The CapM formula says the only thing that matters for, say, IBM's return is only its correlation or its relationship to the market, right? So how do I account for the fact that size and book-to-market ratio matter? Well, fama-french created a model that kind of combines CapM and also accounts for these two factors. So here's our CapM formula. And here's fama-french. And what fama-french say that a return on any asset is equal to at least the risk-free rate, although he uses T-bills, or they use T-bills. And then he has three betas. The beta of market risk goes similarly calculated as we just did. So that looks like CapM. Then he has two more factors, one related to size of the firm and one related to the book-to-market value of the firm. So if we go to our data, what you find is I added some data I got from the Ken French's website. And that data is monthly market minus risk-free rates, and that's actually T-bills. SMB, which is the return on small stocks minus return on big stocks. So I think he takes the return on the one-third smallest stocks in the U.S. minus the return on the biggest stock. So if you're looking at this negative 2% for November of 2014, what that means is in November of 2014, small stocks underperformed large stocks. But in October, small stocks outperformed large stocks. And SMB means small minus big. So the return of small minus the return of big stocks. And then HML is French, or fama-french's term for the return on high book-to-market stocks minus the return on low book-to-market stocks. So you can see actually last November in 2014, actually high book underperformed low book. Let me just take the average of these three. So if I take the average of these columns, and annualize it by multiplying by 12. And I'll do the same for the other. So I just took the average of those columns, multiplied times 12. And I'll change those percentages. And I'll go home, layout, and change it to a calculation. So it's simply the average times 12. We could use these as risk premiums, fama-french risk premiums. Over this 11-year period, stocks have outperformed bills, T-bills, by 774 basis points annualized. Over this period, small stocks have outperformed large stocks by 130 basis points. And over this period, high book-to-market stocks have outperformed low book-to-market stocks. So this is the persistent effect that I mentioned. Small stocks tend to do better, and high book-to-market stocks tend to do better. So we're going to use these as our risk premiums. Now, ideally, I'd like to go back and say, look over 50 years and estimate these factors, but we'll just use these for now. So now, to do the fama-french formula, I have now three risk premiums. The risk premium of market, size, and book value. Now I need three betas. And how I'm going to get those three betas is I'm going to regress excess returns of IBM, J&J, and Goldman Sachs against those three factors all at the same time using a multivariate regression and get three betas. So first thing I'm going to do is I'm going to calculate the excess return of IBM. Just take the return of IBM minus the periodic risk-free rate, which was 0 last month. That's the T-bill rate annualized. I'm going to put a dollar sign in front of the risk-free rate. Because I want to slide this across and not have it move. And I'll copy that down. Let me go down to the bottom, make sure I don't have to trim some data. Well, it looks like I do need to trim some data off at the bottom. Go back up. So now these are my excess returns of IBM, J&J, and Goldman Sachs. So now I'm going to go to Data, Data Analysis. You make sure you need to have the add-in loaded in for the analysis toolpack. Choose Regression. Okay. I need a Y variable, so we'll do IBM first. I'll grab the IBM Returns. So that's the array of IBM Returns. And then my X explanatory variables are the returns from fama-french, market, SMB, HML. And since I included the labels when I selected that data, that first row were words, I'm going to click on labels and let me put the output somewhere to the right of my spreadsheet. So I'll put it here and say, was it X14. So I have the Y input is the returns of IBM including the label. The X is the market minus risk-free, SMB and HML from fama-french. Click on output range and put in a cell that's not going to interfere with the rest of the spreadsheet and hit OK. Here's the results of the regression. So my IBM regression had an R squared of 30%. The intercept of the regression, and then here are my IBM fama-french betas. The beta to the market is 0.76. To size, it's negative 0.07, and to booked, it's negative. And I'm going to change that cell style to input because that's now an input to one of my models. So what this is telling me is IBM has a little bit less than market risk because it's less than 1. And the betas to size and book are negative. So what that implies is actually IBM is a big stock and has high or low book to market. So actually when I apply my fama-french formula, these negative betas times those positive premiums are actually going to drag down IBM's return. Now if you did say this exercise on a very small cap, so a micro cap, what you might find is this SMB beta turns out to be a very positive number, a high positive number, and then fama-french would forecast it to be a high expected return because historically small caps have outperformed. So now I can do my fama-french expected return. Let's go back here. Before I do that, let me make life a little bit easier. I'm going to stack these risk premiums here so I can use a sum product. So these are my fama-french risk premiums, and that's to market, size, and book to market ratio. And now I can use the fama-french formula. And again, the fama-french formula is the risk-free rate plus the 3 betas times the 3 risk premiums. And I'll use a sum product to do that part. So I'm going to, and also since fama-french use T-bills and not T-bonds, I'm going to use this risk-free rate here, which I gave it a name range of FFRF. So I'm going to say equals FFRF plus sum product. All right, it's going to be the product of the sum, or the sum of the product of some numbers. I'll take those risk premiums. I'm going to anchor those because I want to use this formula later. And I'm going to grab the 3 betas. So there's my fama-french. Now there's a little format thing pops up, so let me get that back to 2 decimal places. So my fama-french estimate of IBM's return is 576. Now I can do the same thing for J&J and Goldman Sachs, but I need to run 3 more regressions. So let me just run those regressions. So I know that IBM, the X variables stay the same, so I just need to make sure I go from IBM and T to J and J and U. So I'm going to do data analysis, regression, and I'm just going to change that to a U to be J and J's returns. And let me change the output. I'll put it below here and hit OK. So now these are my J and J betas. Notice J and J is also not small. It's got a negative beta related to size, but it does have a positive beta related to book to market, so they must have they're at least correlated with the returns of low book to market or high book to market stocks. I'll change the format on that. And I can just use my formula for CapM, or I'm sorry, fama-french. Copy that over. And all I need to do now is change this to be J and J's betas. Change that format back. So there's my J and J return based on fama-french. And if you did the last one, you'd find that you get an expected return using fama-french of 11% for Goldman Sachs. All right. Now, the last thing I want to show you as far as calculating, well, let's talk about fama-french for a minute. The advantage is you generally get a higher R squared, and meaning, because generally you just have more variables, so 3 variables will generally increase your R squared. And also the fact that fama-french accounts, or at least includes the long-term persistent outperformance of small cap stocks and high book-to-market stocks. The disadvantage of fama-french is we're not exactly sure why size matters and why book to market matters. So the theory is a little bit iffy as far as why this matters. We're just going to use it because it does exist. And also, there's more model risk in fama-french. You need to calculate 3 betas and 3 risk premiums. So you have to think about what time horizon to do, and do I adjust betas, and do those betas just over time. Now, fama-french may be preferable, especially if you are looking at, say, small cap stocks, and also you feel that those size and book to market factors will be important in the future. The last thing we'll do is talk about how you can use fundamental analysis. Say you know an analyst on Wall Street that tracks IBM and does forecasted cash flows of IBM, and you call them and say, hey, can you send me your forecast of IBM cash flows, including a terminal value for the next few years? So they say, well, I estimate that free cash flows are going to be $20, $21, $22, and $23 per share, and based on a model assumption at the terminal value year here, either using, say, a free cash flow multiple or growth perpetuity, I think it'll be worth 138. You can do an IRR of, if the current stock price is 162 and you believe your friend's data, you can say, well, I have an IRR of this investment if these cash flows do come out to be 858. So that's a connection between fundamental analysis and expected asset returns. So we could use these to the extent that you trusted your analyst. I think we said this was 11.11%. We're just going to cheat there, 11.13. And I'll grab these fundamental analysis estimates. And there I have it. I have my expected returns of the assets. So, in this exercise, we've looked at trying to estimate expected returns. We first looked at historical data using arithmetic and geometric mean. We calculated CapM, global CapM, fama-french three-factor model and IRR returns based on fundamental analysis. Ours are full spreadsheet. So hopefully you know how now to calculate historical returns using monthly data, annualize them, calculate CapM returns by calculating a beta against a market index, choosing the current risk-free rate and a market risk premium, so you can calculate your CapM, global CapM returns, and then calculate a fama-french three-factor model return. The first place I would go is to the fama-french website or Google Ken French data, and you hopefully will wind up at his website that has the size, book, and market factors, and you can line them up to your stock returns, run the regressions, get maybe historical values for risk premiums, and calculate fama-french three-factor models. So that's it.